So, we've had some great panel discussions so far about international partnerships, about investor caution. Obviously, Africa is very rich in minerals, and it'd be great to kind of understand, Mametja, from you, kind of where you think the opportunities are.
Thank you so much, Alisa. My name is Mametja Moshe, and I am CEO of Moshe Capital. We do corporate finance, and we also invest in a number of sectors, including mining.
And Mametja, if you want to do a PR thing, you need to pay to have your brand up here. She's my
Next
friend.
year.
She's my friend, so I can do it to her. Next year, can you pay?
So, Alisa, I think we've spoken about critical minerals in Africa. I think we all are aware of the critical minerals. We have more than 2/3 of cobalt. We have, graphite, all of it. But I think what I would like to concentrate on is why would anybody come to Africa as a jurisdiction for those minerals rather than anywhere else, right? Because we have competition. The dollar that I have in my hand is competing with Chile. It's competing with Australia. Why would anybody come to us? And everybody has spoken about the youth that we have in Africa. So that's one of the key reasons. And the second one, obviously, we have untainted resources, if I can call it that. So we still have resources that need to be explored, and therefore you can actually come up with good and new technologies to mine those, and therefore resulting in lower costs. I think we just spoke about that from the last panel. Lower cost, meaning that you can actually sustain all cycles of your commodity pricing. Thirdly, array of land, which means that you can put other energy sources such as renewable energy. We do not come without our challenges. The biggest being infrastructure. But I think Einstein told all of us that where there is a crisis, there is an opportunity. This is an opportunity for mining companies to partner with government and also partner with infrastructure funds or infrastructure investors. So triple Ps have worked, and we have seen them work in Africa. The ArcelorMittal in iron ore in Liberia, RBC, Richards Bay coal terminal in South Africa. We have so many examples of those partnerships. So if you're a long-term investor seeking to actually unlock minerals in Africa, there is an opportunity to actually partner and unlock those infrastructure, the rail, the ports, etc. And then I think other challenges around security. People always worry about security, and there I think that there is something to be said about partnership with communities, and we've seen this multiple times with partnerships with your communities. What actually ends up happening is you actually have them as your ally, and that helps in social security to actually operate in those jurisdictions. So yes, the minerals are there, and I think we have an opportunity of creating the right partnerships to unlock that in our jurisdiction.
Great, fantastic, thank you. Amanda, actually, I'm curious for your perspective, whether you agree with Mametja's assessment, and whether you think Africa is competitive, and whether there's more that different African governments can do.
The answer is always half yes, half no. In terms of who are Africa's main competitors, I completely agree. The reality is, in terms of critical minerals endowment, in some areas, Africa does very well. In terms of their potential for graphite and cobalt, they're a majority. But net, only 20% of the critical minerals resources in the world are located in Africa. And Africa is competing with the rest of the world in some extremely established mining jurisdictions to develop its critical minerals industry as a specific subsector of the mining world. And it's competing against the advantages some of those countries have. The biggest one being infrastructure, mining 101. You need to get reagents in and product out. And Africa has real challenges in the infrastructure department. You need energy, both diesel and, if you can get it, low cost, low carbon electricity. You need a skilled workforce. You need efficiency. These are all things that have been challenges, and access to capital. All of these things have been a challenge in Africa, and governments in other parts of the world who have now woken up to the need and desire to secure critical mineral supply chains are massively incentivizing their own industries to try to develop their critical mineral resource supply chains and be competitive with China. Then again, credit where credit is due, the African projects that survive, the ones that do get funded despite these challenges, are because Africa's got some extraordinarily high quality, high grade projects. And those are the only ones in the critical mineral space getting funded. Some incredible copper, the only cobalt, some really great graphite, to be fair. But you need to be one of the best projects if you want to get funded in Africa to develop your project. And governments that have the competition with the West, that Africa is definitely in competition with almost every country in the world when it comes to critical minerals and developing their critical mineral sector. And there are some governments in Africa who have risen to the challenge, and they're emulating those competitive advantages and trying to work with, and they're doing well. But it is a global competition, and Africa is fighting for its place there.
I mean, you talked about kind of some areas doing really well. Could you elaborate?
Some countries, specifically, and we can talk about it later, have done a really good job in becoming competitive. I'll use Angola as an example. They helped facilitate, Angola, nobody wanted to invest in them 10 years ago, to be fair. They've redone a really fair, effective mining code. They managed to attract incredible investment through the Libido corridor to build infrastructure. They've got really fair and competitive resource rents in terms of a really good mining code and a patient mining code that's been tested. Their resource rents are fair and competitive with the rest of the world. By that, I mean their taxes, their royalty system. All of that is really good. There are countries that are saying and they've put they've taken the money they've made in both oil and other resources and put it into a sovereign wealth fund that invests alongside Western investors to unlock the opportunities. They put their money where their mouth is. It's a great example of a country that's really said that they are open for business and they're ready to compete and to make their resources and their mining industry part of the game internationally. And I think a lot of countries in Africa, it's a great model for how to become a successful critical minerals player.
Fantastic, thank you. Ben, you're the lead for mineral supply chains at the OECD, and we've talked a little bit about responsible mining. Do you think that responsible mining and the standards could level the playing field?
Yeah, I mean, that's a great question. I think it's a question on a lot of people's minds, and standards, of course, can cut a few different ways. We're at the OECD and the Center for Responsible Business Conduct, where I am at the OECD. We're the custodians of a series of standards on RBC, in particular the due diligence guidance on responsible mineral supply chains. And I say that to situate us because actually I think while this standard and all RBC standards at the OECD endorsed, of course, by our governments as well as many governments in Central Africa and around the world, they are really intended to foster responsible engagement and investment across the world, including and perhaps especially where there are serious human rights and other RBC risks. And I think that's often misunderstood. I think standards are sometimes misused, often within the framing of a more rigid compliance framework. And that brings me, of course, indeed, to how standards can help foster a level playing field. And there are two dimensions to this. One is a level playing field for countries, in this case for African mineral producing countries, and the other is for companies. So I think in the first instance, our standards are intended to enable companies to invest in and engage in countries no matter what the risk profile is, to do so responsibly, to counter de-risking in the process, de-risking in the sense of simply blanket disengagement or avoiding certain jurisdictions. I think also this contrasts with sometimes the way companies go about ESG investing. Sometimes it's just about divesting from risky investments, trying to sanitize the balance sheet. Whereas what this approach is really about is transforming supply chains. And I think in a perfect world, of course, that would put African countries, among others, in a better position vis-a-vis investors, vis-a-vis the whole value chain. And in terms of when it comes to companies, of course, in order to create a level playing field, we need companies to be held to these standards. We need consistency. I think right now, while we have an emerging architecture on due diligence and some level of coherence built around our standards, just to name a few, in US, European Union legislation, recently, of course, the battery regulation, but also the so-called conflict minerals regulation. We have legislation in the DRC, in Colombia, in the UAE, as well as industry requirements in China, the London Metal Exchange, the London Bullion Market Association. I could go on, but essentially there is this coherent architecture, whether it's legislation or whether it's market requirements, that is intended to create that level playing field, but I don't think we're there yet in practice. The system so far is too leaky. So, material is blended at various points of the supply chain. Audits aren't fully capable of kind of capturing which material is coming from supply chains where there are risks that have not been mitigated, where there haven't even been efforts at that, as opposed to rewarding companies and players that have. There's structural opacity in some parts of the supply chain. So you take the 40% of heavy rare earths that come from Myanmar. At this point, it appears to be nearly impossible for companies to conduct on-the-ground risk assessments of that. And there are other, I think, long-term issues such as international fragmentation, receding political commitments. So just as we have sort of this opportunity to seize when it comes to the strategic partnerships between African countries and European or Western countries, we also have in some cases, I think, other political priorities taking precedence. And that, of course, presents the risk that policymakers make short-term, kind of get into a short-term mindset where they want access to supply as quickly as possible, they're willing to cut corners, and of course, later in the 5, 10, 15-year time frame, that comes back to bite in the sense of integrity commitments having been, having kind of fallen by the wayside, periodic shakedowns, all that kind of unpredictability getting worse.
I mean, aside from ESG and supply chains, we've also talked in previous sessions about rising resource nationalism. I want to kind of ask you a question, Mametja. Do you think there are ways of essentially allaying concerns that people have about rising resource nationalism?
Alisa, that's a very good question, and one that is always on everyone's minds when they think about, a long-term investment that mining has. But I think we need to look at what is the ethos behind nationalization, right? Because in some instances, we always see it as all wrong, expropriation, etc. But I would like to take us on the good, the bad, and the ugly of nationalization. On the good, I mean, we've seen post-COVID, there have been other countries as well that have been thinking about nationalization of some of their strategic resources, including Canada as an example. And in the ethos, the good ethos, it is really about how do we actually keep economic returns and prosperity for our country. And I think that is the good that most of the governments are thinking about when they think about nationalization. However, I don't think that it is always so binary. Is it all in or all out? There is a model where government can own equity in resources and use those funds appropriately for the better of the country. And what comes to mind is Botswana. Look at Botswana and how, in partnership with Z.B.S, has resulted in a good outcome from economic development of the country to, providing education, to infrastructure development in some ways, and also to other things such as beneficiation, having local polishers and, transferring some of the skills to Botswana. And then I would come to what I would call the bad. I don't know whether, I think people in this crowd do not know that movie, The Good, the Bad, and the Ugly. I mean, too young. Yeah, Stacey knows it, yeah. So on the bad, I think it's around politics, right? It is done for political reasons. And I'm South African, and we've seen it in some instances. And I still remember a day, back in the day I was working for Morgan Stanley, and an upcoming leader said, we're going to nationalize our resources. Of course, the markets tanked, and people started investing less. So really, if it's just politically driven, it is really terrible for the country. And what I call the ugly is then the corruption part, where it is done for personal benefit. And we have seen that in other countries as well. I will not mention which ones in particular. So I think done well, nationalization in a different form, where you actually are looking at what are the strategic resources and how can we best find economic returns and development for our country in partnership with international investors and mining companies that come in, so that it's a win-win benefit. That actually works. And I think the key again, and I think Deshni mentioned it in the last one of the panels, is about partnership. Where there is great partnership, you actually can find a win-win solution around these matters.
Thank you. Amanda, as you're heavily invested in African mining, I'd just like to kind of understand your process of how you think about de-risking investments. And one of the things that we talked about was about government-to-government investment treaties, investor protections. It would be great to hear a little bit about that.
So I have sort of 7 points in terms of a checklist saying, can I invest in this country? Is my foreign direct investment going to be safe here, insofar as it's mining? And one of the first ones is, can I invest via bilateral investment treaty? That question earlier about bilateral investment treaties was me. They're incredible. They are the best form of political risk insurance for investing in Africa, for any foreign investor that's going to take the highest risk investment in the equity. So finding a bilateral investment treaty that's available that I can work through is really important to me. The second thing that I'm looking for is infrastructure. Is there access to reasonable infrastructure for the project I'm investing in? Because I need to get reagents in and I need to get product out if I'm going to make money. Then I want access to energy. Can I get oil and gas are part of it, but also can I get reasonable cost, low cost electricity, preferably low carbon if I can get it. Access to money is really important, access to capital. Is there capital available to invest in this country from various sources? Do I get a skilled workforce? That's important to me. A good mining code, and by good, I mean fair resource rents. I don't want no resource rents, but it has to be fair and competitive with the rest of the world. By that I mean the taxes and the royalties and the whole regime. And is it a good and patient mining code that I can work with? And so those things, you put them all together and you have an investable country in Africa. It's a lot to ask. I acknowledge that. But there are a lot of more and more countries that are coming up the curve to offer those things and to be competitive with the rest of the world. And the best projects in Africa are getting financed in those jurisdictions that can provide all of those things.
So Lisa, I'm busy typing the question for afterwards to her. So which projects are you invested in which countries? But that's for later.
So, I mean, I think, Ben, if I come back to you, we talked about kind of responsible mining. We heard a little bit from the previous panel about investor caution, but we also heard about sustainable funds, climate funds. Are there other opportunities for African jurisdictions to attract responsible investment?
Yeah, I mean, of course, our work is centered on responsible business conduct, but it's also clear that that's not a panacea, whether a government adopts legislation, whether it's in line with international regulations or expectations. That's helpful, it can be. But I think there's part of it that's about signaling and an important part of it that's about execution. They both kind of go hand in hand. I think it can be helpful to have certainly a supportive policy environment for due diligence and responsible business conduct, because no matter where you are, whether it's in Africa or other jurisdictions, problems will happen. Whether that's social license to operate, whether that's integrity issues, or more serious human rights or conflict financing issues, they do happen. There needs to be allies within host governments. There needs to be local expectations, holding everyone that's invested accountable to them, to RBC kind of expectations. What's really important, I think, though, is a constellation of other policy issues that go hand in hand in host countries with RBC. So that would be when it comes to the mining code and any legislation that does exist on RBC, is it enforced in a consistent way? Is it enforced in an even-handed way? Does everyone have the same recourse to the same institutions? Cooperation across jurisdictions, so across the value chain, can be really important. Often in settings of fragility or institutional weakness, there isn't necessarily the capacity among regulatory authorities to hold companies accountable, and in this case, it's really important that there be communication and cooperation with other jurisdictions. I think important for both signaling and execution is empowering within governments champions on integrity and anti-corruption to convey to the market that this is real. I think upholding standards for corporate governance of state-owned enterprises is really important, because often SOEs can be gatekeepers. They play a really important role in the mining sector. In the case of Angola, I know that since important reforms took place of the important SOEs there, they've been getting in better bids. In other contexts, it's foreseeable that dividends could be increased. When it comes to fair resource rents, I think this is really where better governance of SOEs and in general good mining codes can play a role, because base erosion and profit shifting is a huge problem in Africa. And African governments should expect more, but in order to attract the right caliber of investor that will play by the rules, there needs to be a supportive policy environment in place. I think clearly we've heard about MDBs and new MDBs, or MDBs who had left the extractive scene coming back. European Investment Bank comes to mind, and they'll be very exacting in terms of what ESG expectations they have in mind. So that's an important factor. And then also, I think when it comes to signaling how public revenue is ultimately used is really important. In some cases, public revenue can go into a black box and nobody knows what happens to it, and that's really, I think, discouraging for a high caliber of investor. When it goes into infrastructure that will actually help amortize investments, I think that's really good for long-term stability, for financial stability, and also conveys a good governance outlook to investors.
Great. I don't know how we are for time, but I was wondering whether I had
In front of you, 8 minutes and
8
19
minutes, okay.
seconds and counting.
So you have 8 minutes. It's a question for all of you. I mean, Amanda, you already mentioned Namibia, but Angola, but it would be great to hear from you which countries you think are the ones to watch over the next couple of years. So, Amanda, how do you?
in terms of, I'm going to give myself away a little bit here. In terms of countries that we are invested in, Tanzania and Botswana. In terms of my favorite countries, like as in I know I can invest in this country and my capital is going to be protected, my top 5, may or may not surprise you, are Angola, Eritrea, Botswana, Morocco, and Gabon. In terms of countries I'm watching very closely, because despite, ironically, their former resource nationalism, which scares everybody, they've made incredible strides in working with, of all people, China. And China may not have the world's best ESG track record, but 20 years ago, they decided to invest in both Africa and critical minerals, and they have developed the largest, most effective critical mineral supply chains and the most commercially available critical mineral supply chains, and they invested in Africa when nobody else was willing to. And they invested in 5 countries who have really turned a corner, and I'm watching very closely. And those countries are South Africa, Zimbabwe, Tanzania, Zambia, and the DRC.
Okay, that's a pretty comprehensive list. That's fantastic.
That's 10, unfortunately, it's 10 out of 54 countries in
Yeah.
Africa, which actually I think is a little bit sad that I've got, 10 out of 54 countries on my watch list. I'm not sure that's, I wish I could do better than that.
Ben.
Yeah, I mean, I think, we're coming at it from a different perspective than an investor would. I mean, we're looking at where is there the intersection of international supply chains or international value chains connecting African countries with tending to have large amount of resources and also a nexus with, serious risks related to responsible business conduct. But I do think, of course, I mean, our eyes are really on the same neighborhood in terms of Southern Africa. That's partly because there are all these synergies between the kinds of reserves that different countries in Southern Africa have. There's, of course, interest in exploration among different MDBs and policymakers into an industrial ecosystem in Southern Africa. I think, I would probably, if I were an investor, I'd probably look to be as realistic and measured as possible when it comes to that. I do think that there are opportunities for value addition, but I think they're probably incremental. They depend on energy and infrastructure upgrades. I do think, I mean, our eyes are always on the DRC because of a lot of this work on due diligence began there. And I think, I mean, based simply on the abundance of resources, also continued risks at the same time. But I also think I would watch Madagascar for critical mineral resources and also some very positive signals from the government in terms of integrity and regulatory advances. I think also Mozambique and Tanzania. So this whole kind of Southern African crescent where there are a lot of synergies in terms of the reserves, their interest by Western policymakers, and of course always China when it comes to investment in the minerals and perhaps to some extent in some beneficiation.
Thank you. Mametja.
I think it's a tough one for me because I am African, and if I leave out my country, it will be a problem. So I'll start with South Africa.
Okay.
And and the reason, I was listening to Amanda and on what she would invest in, and I realized we have most of that, and some of it is broken, needs mending, but we are actually working on it, on fixing it. So, and again, as I said, in times of crisis, there is great opportunities. So perhaps it actually is time to actually get those assets as people leave at better pricing. And as for the other things like our infrastructure, electricity, I can see South Africans and South African CEOs smiling and nodding. Yeah, I'm doing our PR. So, but on a serious note, on our electricity, we're working on it. Our ports and rail, there is a plan around it. So maybe it will not be unlocked today, but it will be unlocked in the near future. And then Botswana, places to invest where you know a regulatory environment and how it works and how it will flow. Botswana has gotten it right. And then I would put Tanzania You know, I remember one of our clients about a few years back, to 2019, when there was a lot of talk around nationalization of resources in Tanzania. They went in and did an investment there, which then they invested in. Sorry, they listed on the New York Stock Exchange a few years later for $1 billion. So again, taking care of, you know, in terms of crisis, if you have great partnership, and how they unlocked it, which I think is quite important, was actually partnership with the government, understanding what the government needs, and how can they actually have a win-win situation. In the end, that project really worked. And then Namibia. I think Namibia is also good in terms of regulation and unlocking, you know, the minerals that are there.
Amazing, fantastic. So I think actually we've got 2 minutes to spare, but I'm going to hand back to you for questions from the audience. Thank you very much.
Thank you. The questions fall into a few categories, so let me group them as far as I can. So there's a question that sounds very South African, but so are mining companies actually, as soon as they can, relocating for either capital purposes or for head office purposes or lifestyle purposes for the executive? So I mean, is Africa the place where the company starts and then it goes somewhere else?
So I look at a lot of juniors.
This feels like an Anglo question, but
Yeah.
it's not called that. I don't want to put the elephant, I don't want to put a name on the elephant. But
So I think that it depends on what you're talking about, juniors or majors.
where should juniors be headquartered? Where should majors be headquartered? Let's tackle this vague question like that. Thank you, Amanda.
It's twofold. Sorry, and it's actually one of the things that pisses me off the most in juniors and majors. How you intend to run an African...
Did you just say something pisses you off? We're at a mining conference, finally. I mean, with all this polite English this morning, I was feeling not at home. Thank you. We're at a mining conference. Amanda's pissed off. What pisses you off?
That a bunch of people sitting in London and Toronto are trying to say that they're running a company in Africa. How are you supposed to run a company that has a huge footprint, physical footprint in Africa from London or from Toronto, which they often do? I want to see boots on the ground. I want to see offices located.
But this is a junior, we're having a junior conversation now. Also the majors.
Also the majors. You can't run an operation remotely. It's just not possible. You can finance it remotely, but you certainly can't run it remotely. I want to see people in country, expertise in country, people who are close to the coalface. So from my perspective, as in where they start, usually the money for juniors starts in the West. So you have a bunch of people willing to risk some investments in other jurisdictions, but they need to put boots on the ground sooner rather than later. And it's a balance. The money is usually located someplace else, but you need effective management and expertise in country if you want to not lose all your money. Sorry.
Thank you. I got a very good answer out of the question, which was a bit loaded.
May I add to that, Bernard?
Sure.
It goes back to that question about where your dollar goes, right? I think as companies grow and become bigger and diversify, I'm treading on very thin ice here, but as companies grow and now you're becoming a global player, there is this whole demand for my dollar. It's you know, I'm looking at projects everywhere, and where am I going to put my money? So that for me is the first thing, you know. And then the second one, I think there is a bit of alignment on where is the best place, and especially for the bigger players that are diversified, where is the best place for me from a jurisdiction point of view to be able to achieve that. And then the third one, I think, for me is, you know, I believe as Africans, I don't know how we actually get this right, but we need to actually get to a point where we have the right legislation that supports Africans putting money in Africa as well. It's not like we don't have the money. There are pots of capital that can be unlocked by the right legislation in Africa.
Thank you. I want to go to a question from the infamous Anonymous. How does the panel, so Ben, I'm coming to you with this question first. How does the panel see companies balancing ESG and IFC standards on the one hand versus some African countries' need to prioritize, say, perhaps the social factors? So I personally don't see a contradiction, but the question is as if we have to choose between either or. So expand a bit on that. How do you see that?
Yeah, I mean, I kind of understand where that question's coming from because, I mean, increasingly when we do missions, whether it's roundtables or it's consulting with policymakers in Africa, increasingly we hear, say, I don't know if they're grievances or irritation, you know, that we're not just looking for markets anymore, we're looking for investment. Almost like, well, what has due diligence or ESG done for us lately? And I get that. I mean, it's been, you know, in some ways the last 15 years because we've seen more of setting up of regulations, setting up of audit systems. We've seen more of that, I think, than actual good practice. And good practice to us looks like more like actually making investments to make these supply chains better performing, which I think goes hand in hand with productivity, with more tax revenue, basically with more of the pie left over for African countries. But I think ESG and, I mean, what we more often call RBC sometimes gets a bad rap because it's the side of it that's more sort of the theoretical, that's setting up the audits, basically all the stuff that entails costs but doesn't result in concrete impact on the ground. That's kind of what we've been focusing on the last 15 years, and we need to see more action in the field. I think if that's the case, it will, you know, those two objectives go hand in hand.
Can I
Please.
add to that answer?
Yeah.
The ESG has been a big topic for a long time, but in the mining industry, ESG is pretty much business as usual these days.
Yep.
The reality is, unless you have IFC performance standards, which are the gold standard, embedded into your company and your activities, you're never going to get financed and you're never going to get into production because the reality is your social license, environmental and social license to operate is as important as your mining license, from which probably potentially more important. And much like health and safety, that's been put in. We're there. We know what those check marks are, and we have to do it. But on the other hand, you can't, and frankly, you can't get financed without it. But you can't sell standards. ESG alone is not going to make your project successful.
You may still need a good ore body.
Yeah.
Amanda, so well said and well summarized. I warned up front that I'm stealing 5 minutes back from you guys because I messed up. So apologies, especially to the online people. It is so rude to not be on time. It was my mistake. But thank you very much for a good conversation. And what will be more rude than anything else is to keep people any longer from lunch. We are the panel before lunch. So thank you very much. Thank you, panel.
Thank you very much.